And in important news, SEBI has proposed to ease IPO regulations for large companies with market cap between 50,000 rupees to 1 lakh crore. And among other proposals, SEBI has also batted for keeping the retail quota in IPOs at 35% instead of cutting it to 25%. Let's now go across to my colleague Charu for more on this development.
Hi, so the market regulator, Securities and Exchange Board of India, has come out with a very interesting draft paper, which is going to affect the retail investors as well as big companies gearing up for IPOs alike. So what has been proposed? Firstly, smaller firms, smaller companies which have a market cap of up to 50,000 crore rupees are largely unaffected by this. But companies that have a market cap of about 50,000 crore to 1 lakh will have to give shares worth about 5,000 crore rupees to their retail investors. Companies that have more than 1 lakh crore rupees market cap, they are going to have to raise about 6,700 500 crore shares to their public shareholders, or about 2.75% of their public shareholdings has to be garnered. Apart from this, giant companies are the ones which are going to be affected a lot, because companies which have a market cap of about 5 lakh crore rupees or more than that will have to shell out over 15,000 crores worth of shares to the public shareholders, but they can keep the percentage to 1% or 2% and will be given enough amount of time to reach the 25% share threshold. So what is this 25% threshold thing that SEBI is coming out with? First, companies will be given time to reach the 15% public shareholding, and then they will be given more time to reach 25% shareholding. If a company is listing below 15% shareholding, they will be given 5 years to reach 15% mark, and then in 10 years, they will have to reach 25% mark. If they are listing above 15%, they will have to reach 25% mark within 5 years. Now, this is something which eases the IPO norms for the bigger companies, because they will not have to shell out a lot of public shareholdings immediately. Apart from that, the regulator had earlier come out with a proposal to reduce the retail participation from 35% to 25% in large IPOs, but it has, based on some feedback that it might have received, refused to go ahead with that step and taking those proposals back. But public consultation on these new set of proposals are going to be open till September 8th.
Right, Charu. Thank you so much for bringing us those details and breaking down the SEBI's new IPO playbook. But to discuss this further, I'm being joined by Astha Jain, Senior Research Analyst at Securities. Thank you so much, Astha, for giving us your time. My first question to you would be, how will the reduced share sale requirement at IPO benefit large companies valued above 50,000 crore, and what challenges might they still face?
Hi, good evening. See, what I want to say, first of all, this proposal which the SEBI has revised, again, I'm really very, very happy with this, because first of all, if I talk about the retail investor, however, you asked the question about the companies. So definitely the companies will get benefits, especially the large companies, because when they come out with the IPO, now the norms are much more relaxed for them. Now the time period has been extended. So definitely when they come out with the minimum shareholding dilution percentage, and afterwards they get the ample time to, reach the ample level or the standard level of 75% shareholding pattern. So I think this is really beneficial for the companies or the corporates. Now, if I talk about the retail investors also, retail investors will also get benefit from this. Again, SEBI, which has put the paper in the public domain, because I think retail investors nowadays, they are participating in a very, very large way, and cutting the retail investor portion from 35% to 25% is, I think, is not that very, a prudential step. Why? Because ultimately what we have seen, Malika, in the past also, whenever some big IPO come and the retail quota is not filled, automatically it will get spill over to QIBs. So looking after the fact that if the retail quota is not filled, then again it will get spill over to QIBs. There is no, I think, need for the SEBI to cut down the retail investor portion, just looking after the fact that retail might not participate. So I think this proposal which the SEBI has put in again in the public domain is a very strong proposal, and this is very beneficiary for both public as well as corporates.
Okay. Very interesting, Astha. Another question to you is, what impact might the extended timeline for meeting the 25% public shareholding rule have on stock liquidity and pricing for these large companies?
So this impact is really very strong because I think whenever we have seen in the past also that if a company get ample time to dilute their shareholding to the minimum of 25%, then the corporates get the ample time to dilute there, so they can raise the funds, they can fulfill their long-term requirements over the period of a time if the time period is more. Because sometimes when you just raise supposedly 10 or 10-15%, or you dilute only 10-15%, and then the funds come in the corporates, then again when they deploy the funds, so I think it will require more time again for them to strategize their new requirement, to strategize their expansion plan, and the extension of time limit is beneficial to corporates, I suppose, and hence we are very much positive for this part.
Okay, Astha. Understanding that, could you also give us a global perspective on how do SEBI's proposed IPO norms compare to global standards for large companies going public?
So I think now in the global context, I think India is standing out to be a very, very strong market, or especially for the newly listed companies, and especially our primary market is very strong. And the fact I would like to justify with this, because the kind of valuation our company get when they come out with the IPO, they are always larger or a higher P multiple than the global counterparts, and even the institutions or the QIBs are ready to give such kind of high valuation. So India is a very lucrative, very attractive market. And I think at this point of a time, SEBI is trying its best to make it more and more lucrative. So I think this is a very, very prudent step. And this will definitely open doors for more institutions to come in and look after the India as a very strong primary market.
Okay, all right, Astha. Thank you so much for helping us understand these new norms and the effect of it, not just domestically, but also comparing it to the global scenario. Thank you so much for having us.
Thank you.
And now we have